Hello, everyone, and welcome to you all. My name is Maria Kringle, and I manage our self-managed super fund division here at Saward Dawson. I've recently injured my knee and I'm still not able to sit for too long, and as a result, we won't be answering your questions live today. If you have any questions, though, please add them to the Q&A and we'll come back to you after the session. As this disclaimer says, we'll be providing factual information only, which doesn't consider your personal circumstances and is not financial product advice. Now, if you can all make sure you've got your microphones switched off, we'll get started. Today, I'm going to run through the things you should be thinking about in relation to your superannuation as you near retirement. Superannuation is only a part of your whole retirement plan, but given our compulsory super system, it is generally one of the largest financial assets most people have. It's never too early to think about this and how you'd like your retirement to look. The earlier you identify the end goal, the more likely you are to achieve it. So, knowing what you need, what you want, and when all becomes more important as retirement approaches. Consideration also needs to be given to the timing of your retirement. Will it be a set date, or will you gradually wind down into full retirement from the workforce? We'll also have a look at options to maximise contributions, the different tax implications for your superannuation in retirement, and the estate planning matters that may need to be revisited at that time. Now, this is not what you want to experience. When I retire, I'm going to enjoy my life and live off my savings. Not sure what I'm going to do on the second day, though. We don't want to be in that situation. Okay, so you've started to think about retirement. It's probably a good idea to actually write down what you'd like that retirement to look like. Identify your fixed and discretionary expenditure, summarise all of your assets and liabilities, and think about the minimum time frame you have until you leave the workforce. Also think about what you want in retirement. How will you spend your time? Do you have travel plans? Is there any once-off expenditure coming up, such as a new car or a new kitchen? Having a good grasp of all these items will help you to go into retirement with a realistic idea of what you need. It's then just a matter of seeing how your super can help achieve this. When you have looked at your situation and decided what sort of annual income you need to fund the retirement you want, it's good to see exactly where you're at using the free retirement calculators available. Most super funds have them, and there's also a good one available on the MoneySmart government website. You're able to input your income, assets, liabilities, and super for each member of a couple, and you'll get an idea of how long your super will last you, and also if you're eligible for any government age pension. The calculators also allow you to adjust your contributions to super and your retirement date and see the impact this will have. If that all seems too hard, now might be the time to speak to a licensed financial advisor. This is something Saward Dawson can assist you with, so please give us a call if you'd like to take that option. It's also a good idea to have a look at the most recent superannuation statement from your fund to help you understand what makes up your super balance. Identify the tax components of your super balance. These components may have an impact on tax payable when your super is withdrawn by you or paid as a death benefit. The taxable components of your super balance consist of all the concessional contributions made to the fund. That is, super guarantee, salary sacrifice, and any member deductible contributions, plus the growth in earnings. So it's generally the largest part. This category can have two parts as well. The majority of people have taxed elements, which means that tax has been paid when the contribution was made to the fund. But some who were employed by government may have untaxed elements. If you have those untaxed elements, you'll already be aware of it, and I won't go into them today. The tax-free components arise from non-concessional after-tax contributions that have been made. There are three possibilities also for the preservation status of your super balance. Generally, prior to retirement and age 65, most super will be preserved. This means it is locked away and cannot be accessed yet. Restricted non-preserved arises from some employment-related contributions made before 1 July 99. We don't see this category very often, so again, I won't go into any detail about this. After meeting a condition of release that has been reported to your super fund or reaching age 65, your super becomes unrestricted non-preserved. This means that it's now available for you to access. If all the information I've just mentioned isn't available on the statement from your fund, you can contact the fund and request all these details. It's also a good idea to review how your super is currently invested. Heading into retirement, you may wish to consider a slightly more conservative option. While you still want growth, you may also want more certainty that your capital will be protected. It won't be so easy to replace without regular contributions in the future. The timing of retirement is also important. As I mentioned earlier, not everyone wants to move directly from full-time work to full-time retirement. A lot of people want to make the move gradually over a period of time. One of the special super options available is a transition to retirement income stream, also known as a TRIS. This income stream is not necessarily offered by all super funds, so you'll need to check if your fund provides this. From the 1st of July 2024, you need to be over age 60 to commence a TRIS. The annual withdrawals you're able to get are between 4% minimum and a 10% maximum of your super balance, and these withdrawals can be used in a number of different ways leading up to full retirement. Now, everyone has different circumstances, but if you may want to supplement your income as you reduce your work hours. You may also like to use the super withdrawals to help reduce debt prior to retirement. You also may want to use the withdrawals to make additional concessional contributions back into super and reduce your income tax. As you need to be over 60 to commence a TRIS, the withdrawals are not included in your personal taxable income. But be aware that this option does reduce the total superannuation you'll have when you fully retire. Prior to the 1st of July 2017, a TRIS would also reduce the tax payable on income earned in the fund. However, now there is no reduction in the 15% tax payable on income earned in your super fund. It's important to note that commencing a TRIS does not change your super preservation status. Your super remains preserved. As a result, you can't make a lump sum withdrawal from a TRIS. You can stop it, however, but rather than being able to withdraw it when you stop it, it will return to accumulation phase and remain preserved until a condition of release is met. The more common way of accessing your super is to meet what is called a condition of release. Doing this will change the preservation status of your super to unrestricted non-preserved. I've not shown all the conditions of release here, just the ones that relate to retirement. At 65, you automatically meet a condition of release, but there are also two options between the ages of 60 and 65. Firstly, you can sign a declaration that you have retired and have no intention of returning to full-time or part-time work ever again. Now, you don't have to be over 60 when you actually stop work. You can have retired earlier, but you will only be able to access your super if you can sign that declaration. Now, part-time work too is more than 10 hours a week. Secondly, you can cease one of a number of employment arrangements after you reach age 60. The second option allows someone with multiple employment arrangements to leave just one of those jobs and still meet a full condition of release. They can continue with all other employment. Being able to continue to earn an income and also access your super may allow you to gradually reduce your work hours, pay down debt before retirement, and also use other strategies available. So it can be very useful. You obviously have to provide evidence of leaving employment to meet that condition of release. Okay, so we've decided how and when you'll meet a condition of release. Now it's time to consider how to maximise the amount you have in super at that time. First, we'll look at concessional contributions. Prior to age 67, there is no need to meet a work test for any concessional contributions. For super guarantee and salary sacrifice, they can also be made without meeting a work test from ages 67 up to 75. But for member concessional contributions from between the ages of 67 and 75, these can only be made if a work test is met first. Well, not first, in the year that you make those contributions. The work test means that you have worked 40 hours and 30 consecutive days in the year the contribution is made. Now that has to be work for gainful employment. Volunteering, babysitting, things like that don't count towards that. Super guarantee is the only concessional contribution that can be made after age 75. There is no time limit for these contributions, so you can keep working it in some small part of an employment. Now, the annual cap at the moment is $30,000 for concessional contributions. In the last few years leading up to retirement, trying to get as much into super as possible makes sense. It can also reduce the overall tax that you pay, which in turn will increase your retirement savings. Obviously, to do this, though, you must have the cash to contribute and sufficient taxable income to make claiming the deduction of benefit to you. If your marginal tax rate is below 15%, a concessional contribution will increase the overall tax you pay and therefore does not provide a benefit to you. There are also a couple of special options available at this time. One of them is the work test exemption, which applies if you are over 67 when you retire and your total super balance is below $300,000. As the name suggests, this exemption allows you to contribute in the year following retirement without having to meet the work test that year. The 5-year carry forward option is available if your total super balance is below $500,000 at the prior 30th of June. Now, this allows you to take advantage of any unused concessional contributions in one particular year. You can find details of the carry forward contributions you have available on your MyGov account. Just be a bit wary if you've got a self-managed super fund because they're not reported as early as other contributions are. Making additional contributions in the year you retire may be of particular benefit if your income in that year is higher than usual due to the receipt of unused employment entitlements. So it's always something to consider. Also, as we head into retirement, you may, when you know you'll be able to access your super, you may also like to contribute money you've saved outside of super. And this will ensure that the income earned on that money will only pay tax at a maximum of 15%. Knowing that it's not preserved for years and years, but you'll be able to access it soon makes this a more favourable option. Not everyone wants to have all their money in super. You may prefer to keep some outside, but it's worth having a look at the tax implications overall before you make that decision. That's something we can help you with too. Non-concessional after-tax contributions are available up to age 75, and since the 1st of July 2022, a work test is not required to be met between the ages of 67 and 75. The annual non-concessional contribution cap is currently $120,000, and you have an option to also bring forward 2 more years of the cap and contribute up to $360,000 in 1 year. We'll discuss the benefits of a spouse contribution later and how they might be useful. And there is also the downsizer option available from age 55 if you sold a home that you'd owned for 10 years. Now note, I'll be covering all the contribution rules in more depth in our webinar on contribution options, which is scheduled for the 30th of April. So please join us if you'd like a full update. The low rate of tax, 15%, payable on income earned and concessional contributions made to super makes super the most tax advantageous place to save for retirement. It can get even better than that after retirement, as I'll explain soon. When you've met a condition of release, there are 2 ways you can withdraw your money. One is a lump sum withdrawal. This is an amount paid to you directly from your super accumulation account. If you're over 60, the withdrawal itself is not taxable in your own hands. But if you don't spend the money and instead invest in your personal name or leave it in a personal bank account, any income earned will be taxed at your marginal tax rate. There is another way of withdrawing money from your super. This is by purchasing an account-based pension and taking regular pension payments. This involves moving your super from accumulation phase to retirement phase. An account-based pension is opened by your super fund and an amount is transferred from your accumulation account. If you're still making contributions, you'll need to have 2 super accounts, an accumulation account for those new contributions, as well as the account-based pension account. The big advantage of commencing an account-based pension is that no tax is paid on income earned within the pension account. This helps your super to last longer. And to receive this 0 tax rate on income earned, you just need to meet the annual requirement of drawing a set minimum annual pension amount. This is based on your age at commencement or at the 30th of June of the prior year. When you commence an account-based pension, you can make it reversionary or non-reversionary. Reversionary means that it will automatically continue to be paid to your spouse after you die. Now, as you can see from this table, the above minimum pension rates increase as you get older. These are just the minimums required. Additional can be taken any year, but remember this will impact how long your super lasts. The aim of an account-based pension is to fund your retirement. It is not supposed to be a means of passing wealth to the next generation of your family. In practice, though, where large super balances are held and the money is invested well, there may still be money left at the end of your life to pass to your beneficiaries. Now, you can't just put everything into a pension. There's actually a cap on how much of your super you can move into retirement phase. Currently, that cap is 1.9 million per person, and this is called the general transfer balance cap. It is indexed. It commenced back on the 1st of July 2017 at 1.6 million, and it's grown to 1.9 now. It's indexed in line with CPI in $100,000 increments, and it's expected to rise to 2 million per person from 1 July 2025. The Taxation Office keeps a record of how much of your transfer balance cap you have used. If you've used the entire general transfer balance cap available at any time, you will no longer be eligible for indexation. If you have used, for example, 75% of the transfer balance cap and then indexation is applied, only 25% of that increase in the cap will be added to your personal transfer balance cap. If you want to check your personal transfer balance cap, check what it is, it's available on your MyGov account. Now, I mentioned non-concessional spouse contributions earlier. To maximise the amount a couple can have in retirement phase, it can be beneficial to withdraw a lump sum from the higher super balance and make a non-concessional contribution to the spouse with the lower balance. This can mean that maybe both of you will be able to move all of your super into retirement phase. It can also even up balances between spouses, which can provide some estate planning benefits in the future. I'll run through those estate planning benefits next. Okay, now heading into retirement is one of those milestones in life. Similar to marriage and having children, where it's important to review your estate planning. It's a great time to have your wills and powers of attorney reviewed to ensure they still meet your requirements, cover all your assets, and that the executors you have appointed are still appropriate. Some people don't realise this, but super doesn't automatically fall under your will. It will be up to the trustees of the super fund to decide how to pay any death benefits unless you have provided instructions to them. Where no instructions are given to them, they are required to look for dependents. This process can delay the payment of the death benefits. There are a number of ways of providing instructions to the trustees. A binding death benefit nomination must be followed by the super fund trustee. If you want your super to fall under your will, you can direct your super to your legal personal representative, your estate. In most funds, a binding death benefit nomination needs to be updated every 3 years, so this must be monitored regularly. A non-binding death benefit nomination informs the trustee of your wishes, but as the name suggests, is not binding. The trustee must still look for dependents that may have a claim on your superannuation assets. As I mentioned earlier, when you commence an account-based pension, you have the option of making it reversionary to your spouse. This can be a good option in some circumstances, as the pension will continue to be paid. It will just be a matter of providing the trustee of the super fund with a certified death certificate and any changed bank account details. Now, there's a bit of a sting in the tail when it comes to superannuation death benefits. This is where the impact of the tax components mentioned earlier comes into play. Under the superannuation laws, your super can be left to your legal personal representative or to one or more cis dependents. The tax law includes the same definition of a cis dependent, but it also has another narrower definition of defined benefits dependent. It's the narrower definition which is used to determine the tax that is payable on the death benefit. This table shows who SIS dependents are under the super law. It also shows the narrower definition of who death benefits dependents are. There are only two differences between the two columns. The first is that a former spouse cannot be directly paid your super. If you want super to go to them, you need to pay it to your estate and include instructions in your will. They can receive the payment from there without paying any tax, though. The other difference I want to draw to your attention is the fact that an adult child is not considered to be a death benefit dependent. If a death benefit is paid to them, tax will be payable on the taxable components. When a super death benefit is paid to any other death benefits dependent, for example, a spouse, a minor child, a financial dependent, or someone in an interdependency relationship, there is no tax payable, no matter what the components are that make up the death benefit. A super death benefit paid to a death benefit dependent can be paid in two ways, as a lump sum or as a pension. Now, as you'll recall, super benefits can consist of up to three tax categories: tax-free, taxable, taxed, and taxable, untaxed. Tax-free components are always paid out tax-free, no matter how they are paid or who they are paid to. Taxable elements, both taxed and untaxed, paid as a lump sum, are paid tax-free to death benefit dependents, but taxable untaxed elements paid as a pension are taxed at the marginal tax rate of the recipient, less a 10% tax offset. If a super death benefit is paid to a non-tax dependent, which remember includes an adult child, it can only be paid as a lump sum. Again, any tax-free component in the payment does not incur any income tax. The taxable taxed element will have 15% tax deducted, and the taxable untaxed element will have 30% deducted. If the super death benefit is paid directly from the fund and not via the estate of the deceased, the Medicare levy is also incurred on taxed and untaxed elements. So reducing your taxable components, particularly if you have a large super balance that you envisage may pass to adult children, is therefore something to consider in that period between when you retire and while you can still make contributions. Now, I know we've covered a lot today, but hopefully it will get you thinking about your retirement and make you aware of the things to consider. If you have any queries, please add them to the Q&A or contact us directly. If you've realised that you might need assistance with your retirement planning, let us know. Our wealth advisory team would be happy to help. Finally, don't forget we have another couple of seminars coming up. On the 9th of April, we'll look at post-retirement and consider if the planning is over. And then on the 30th of April, we'll look at contributions options. This was rescheduled from the 26th of February. If you're interested in attending, please contact us or keep an eye out for the reminder we'll send just prior to each webinar. Now, thanks for your time, and I hope someone out there is still awake. Thanks, bye.